When prices accelerate at a rate that renders physical cash worthless overnight, money stops functioning as a medium of exchange and becomes a psychological illusion. In Germany, at the end of World War I, a single egg cost a fraction of a mark. By November 1923, that exact same egg cost 500 billion marks. This chart tracks Zimbabwe's monthly inflation rate leading into late 2008. By November, the annual inflation rate hit 89.7 sextillion%. Prices were doubling every 24.7 hours. A financial collapse of this magnitude does not happen by accident. It requires a deliberate breakdown in the trust between a state and its citizens, driven by the very institutions designed to protect the currency. Following the First World War, the Weimar Republic faced an enormous debt burden. The Treaty of Versailles demanded 132 billion gold marks in foreign reparations, an obligation that completely overwhelmed the nation's tax revenues. Decades later, Zimbabwe faced a similar wall of debt. After defaulting on loans from the International Monetary Fund in 2001, the government lost its international creditworthiness and found itself entirely shut out of global financial markets. Both governments were backed into a corner. They desperately needed capital to survive, but they could no longer raise taxes on an exhausted populace, nor could they borrow from abroad. To pay public workers and fund government operations, politicians in both countries turned to the printing press. They chose to quietly create money to cover their deficits, trading immediate political survival for long-term economic stability. Simply turning on the printing press does not automatically trigger hyperinflation. For prices to spiral completely out of control, the supply of real goods in the economy must simultaneously crash. In early 1923, French and Belgian troops occupied the Ruhr Valley, Germany's industrial heartland. The German government called for workers to strike, effectively shutting down the country's manufacturing output. Zimbabwe experienced an equivalent supply shock. Erratic land reform policies decimated the commercial agricultural sector, drastically reducing domestic food production and creating severe national shortages. In both cases, national output plummeted exactly as the central banks flooded the system with new currency. The classic economic scenario of too much money chasing too few goods became a mathematical certainty. Facing these economic crashes, neither government reduced its spending. Instead, they accelerated the printing presses. This text outlines a crucial nuance in the crisis. The Weimar government had to buy foreign currency to pay the Allies. As the mark depreciated, those foreign currencies became increasingly expensive. This created an inescapable trap. To buy the same amount of foreign exchange, the government had to print exponentially more domestic money, which only drove the value of their own currency down further. This rapid devaluation triggers monetary velocity, the speed at which currency changes hands. When citizens realize cash is losing purchasing power, they spend it instantly. This offloading acts as a massive multiplier, accelerating inflation far beyond the new money printed. Central banks are forced to issue absurd denominations just to facilitate basic daily trade. The Reichsbank began printing notes for 5, 10, and 20 million marks. Zimbabwe followed the exact same trajectory, issuing time-limited bearer checks in denominations of hundreds of millions, and eventually $100 trillion. The state becomes locked in a feedback loop. Every attempt to print enough money to solve the crisis only guarantees the total destruction of the currency. Behind the exponential math, the reality of hyperinflation is a profound social trauma. In Weimar Germany, the life savings of the middle class were wiped out in a matter of months. A family's accumulated wealth, stored in government bonds or bank accounts, was suddenly barely enough to buy a loaf of bread. This economic humiliation bred deep resentment. As hunger and unemployment rose, the disenfranchised middle class abandoned moderate politics, fueling extreme polarization and ethno-fascism. Zimbabwe society fractured in similar ways. The crisis led to mass emigration as labor fled the country, businesses shuttered, and major sectors like the construction industry completely collapsed. Hyperinflation is not a victimless macroeconomic anomaly. It systematically dismantles the social and political fabric of a nation. Once a currency enters this death spiral, a government cannot fix it by simply printing money a little bit slower. They have to completely reset the public's psychological trust. In Zimbabwe, the crisis ended because the public spontaneously abandoned the local currency entirely. Citizens refused to accept the Zimbabwe dollar, forcing the government into official dollarization, adopting the US dollar and other foreign currencies to stabilize the economy. Weimar's cure required a severe institutional intervention. In late 1923, a new currency commissioner, Hjalmar Schacht, took action. He stopped the central bank from monetizing government debt and ruthlessly slashed public spending, cutting 1.5 million civil service jobs. The government then introduced a new currency, the Rentenmark. Its supply was strictly capped, and it was backed by a mortgage on all German land and industry, providing a tangible anchor that restored public confidence. There are no painless exits from hyperinflation. The only proven cure requires severe austerity and permanently severing the printing press from political control. When a government refuses to face economic reality, hyperinflation serves as the ultimate hidden tax on its citizens. It is a harsh reminder that paper money only holds value when it is anchored by strict fiscal discipline.